Welcome to episode 61 of the Cashflow Connections podcast. The topic for today is how geopolitics, bonds, and the dollar impact real estate investments. There's a lot of discussions out there that come up frequently in the news that seem to be important, but the actual impact from an economic standpoint or an investment perspective is relatively unclear. For example, what would it mean for U.S. real estate investors if the dollar were to collapse? What would it mean for Main Street if the dollar was no longer to be the world reserve currency? In certain circles, this may come up frequently, but it's almost never followed up with the only question that most people care about: what does this actually mean for me? So today, we're going to talk about these topics and find out what exactly that answer is. So in this episode, we're going to discuss what the current state of the U.S. economy is and how we got in this situation. We're going to talk about some of the geopolitical moves that China is making and what can be inferred by those moves. We're also going to discuss the bond market and why this is critical for real estate investors to pay attention to. Of course, debt is the majority of the capital stack of each purchase, so the bond market is like the largest market in the world, and therefore real estate investors need to be cognizant of what's going on there. And of course, we're going to have a discussion about what all this data suggests about where we should be investing, what asset classes and what property types, what geographic locations best line up with this data. And also, this is pretty cool. We now have people from 12 states coming to the Intelligent Investors Real Estate Conference. This means that we really will be creating a really unique networking opportunity for real estate investors to meet each other from all over the country. Plus, I'm obviously very excited to meet some listeners who are flying in all the way from Virginia and New York and Hawaii. So very much looking forward to that. If you haven't yet, make sure to go to intelligentinvestors2018.com to grab your tickets to the conference. It takes place November 10th through the 11th in Marina del Rey, California. It's going to be awesome. And we're likely going to have 60 speakers, panelists, and guests, all of which are extremely experienced, have a ton of investment experience. So make sure to go over to intelligentinvestors2018.com to get your tickets. Don't forget to use the discount code CFC for $100 off each ticket that you buy. All right, hope you enjoy the episode. How's it going, everyone? Our guest for today is Russell Gray, who is the co-host of the Real Estate Guys radio show, which is one of the longest running real estate podcasts in the U.S. Russ, thanks again for coming on. I really appreciate it.
Happy to be here. Thanks, Hunter.
So let's start with the big picture. Let's start with how you got introduced to the financial markets. What was your kind of entrance into the sector?
Well, without kind of giving you the long, boring thing, the short of it is I was in corporate sales in Silicon Valley and I was doing pretty well. One day I got a tax bill that was as big as my dream salary, which tells you that I was doing well, but it also told me that I was paying way too much tax. So I kind of went on a quest to understand what taxes were, what that was all about. It kind of led me down this rabbit hole of interesting things, one of which was a bunch of tax protest work done by Peter Schiff's dad, Irwin, who I didn't know Peter back then. And then I read a book called Creature from Jekyll Island by G. Edward Griffin. And I began to understand a little bit that our financial system maybe wasn't everything it appeared to be. That was long before the movie The Matrix, which I really think is kind of a great metaphor for our financial system, where human beings are little batteries feeding the machinery with our efforts. The old scripture that says the borrower is servant to the lender. And so I really got curious about the debt markets. I decided I wanted to get out of corporate sales and get into the financial business. Decided that I would make my entrance into the financial business in the mortgage space because I tend to be a little bit more of a numbers and analytical guy than I am a deal guy. And so I started a mortgage company, began doing the groundwork for it in 99, launched in 2000. A little bit after that, I met Robert Helms when I was looking for someone who I could cooperatively market with. A couple of years after that, I became the co-host of the Real Estate Guys radio show, and that was a temporary position that I'm still in some 14 years later. And, a big part of what we did was to market. At the time, he was in brokerage and I was in mortgage, and then eventually we started a development company together, which we still have. And it was really about, using education as a way to generate leads. But then the whole education side of our business became a business of itself. And so it was all good up until 2008. And then in 2008, I got completely wiped out. I mean, completely, like the old game Chutes and Ladders, where you're just about to win and then you get all the way back to the beginning. And so there I am. I'm 48 years old, and I've got no home. I've got no car. I've got no credit cards. I've got no bank account. I mean, it was just a train wreck. And I thought to myself, dang, I'm a hardworking guy. I'm an honest guy. I feel like I'm a relatively smart guy, but somehow, some way, I completely missed this. And so Robert and I started looking around and said, okay, somebody out there knew. Well, we were at the time already friends with Robert Kiyosaki, and he was trying to tell us, but we couldn't hear him. And that was a lot less about him. It was more about us not having an open mind. But after 2008, our mind opened up quite a bit. And that's when we discovered Peter Schiff, and we started following Peter around and became friends with him, got him to come on our annual investor summit at sea for the first time in 2013. And he's been a staple there ever since. And I ended up at a 3-day inner circle meeting with Robert Kiyosaki, and I ended up having dinner with a guy named Richard Duncan. I don't know if you're familiar with Richard P.
Oh, yeah, certainly.
Yeah, who wrote The Dollar Crisis. So anyway, Kiyosaki's a big fan of Richard's, and I ended up sitting at dinner with him. And I was a little intimidated because here I am. I barely got out of high school, never made it through college, kind of a self-educated, fledgling economist guy. And I'm sitting there talking to this PhD that's an advisor to the IMF and best-selling author. And he had said something in the seminar that I thought was interesting. He said that he thought that gold would go to $5,000 an ounce and oil would go to $5 a barrel. And I said, Richard, they're both denominated in dollars, and I can see how either one of those scenarios could happen, but I'm having a hard time seeing how they both happen in the same environment. Mm-hmm. And he looked at me and he goes, that's a good point. I was just like a watershed moment for me. Like, wow, I just made a good point to a PhD economist. But it was such a great experience. And for anybody who's listening, one of the things that you have to get over is your own fear. At some point, you have to be willing to get into conversations with people smarter than you and ask questions, even at the risk of asking a stupid question. And once I kind of got over that hump, then all of a sudden I started having these amazing conversations with Peter, with Mark Skousen, with Robert Murphy. Those are 3 really high-level economists and all kinds of investors. And then I just began studying and studying and studying. And then I started sharing, what I was learning with our audience, because so much of financial media doesn't really talk to real estate investors. They barely talk about real estate. But when they do, they're talking about homeowners or home builder stocks. They really don't even understand what it is to be a real estate investor, much less understand the space. So I think we've kind of carved out a little niche, with the kind of the clues in the news that we do, relating what's happening in the financial news to mom and pop real estate investors out there.
Yeah, and I really appreciate the introduction regarding those details. And it's interesting. Obviously, on the show, we've heard a lot of stories about people losing everything in 2008. But it starts to become a statistic at a certain point. You got to remember, like, what you just described is heartbreaking. It is like if someone built up a portfolio and also thought they were good at business, and something like that comes and takes it away, it's like working on art your whole life and just watching it burn in front of you. And it's just terrible. And the fact that it happens so commonly is just, it's pretty heartbreaking and can do tremendous things to someone's psyche and their family, and just remarkable. So again, I appreciate you sharing that with us. I know it's something that a lot of people that are listening hopefully can learn from. Now, was it when that happened that you started becoming interested in those alternative worldviews? You mentioned the Creature from Jekyll Island, which is a remarkable book. Is that when you started getting into that?
No. That happened in 94, 95.
Okay.
I read that book and I decided that I wanted to get into financial education. And my entree into financial education was going to be the mortgage business. And so it took me from 95, when I kind of figured out what I wanted to do when I grew up, kind of my mission, why I felt like I was put here on the planet. And it took me a while to figure out how to put a business model around that and how I was going to make the transition from corporate sales guy into, the financial education business. And that took about 5 years to figure out. When I launched the mortgage company, the sole purpose in launching the mortgage company was to self-fund the education company. And that's when I was out there doing research on seminar marketing and financial education. I'm a big believer in strategic networking. Obviously met you at a trade show. I go to a lot of trade shows, not for the content, but for the people. That's why, as great as the internet is and podcasts and YouTube and all that kind of stuff, I'm just a big believer in going out and meeting people.
Agreed.
And that's where I met Robert. And it kind of just took off from there. I brought some of my ideas about how to build a financial education company as far as a business model and all of that. And Robert, if you've ever seen him speak, is just amazing. He's one of the world-class speakers, and you hear him and he just moves you. And so he and I have worked together for a long time, not just to share education, but really to create an ecosystem, a place, a tribe, if you will, of thought leaders, of people who are all out there trying to help. And, the mission for us now has really kind of narrowed its focus to syndication and training people how to raise money. Our mission is to move money from Wall Street to Main Street and see Main Street investing in Main Street. That's why we like guys like you. It's why I'm on the show. If I can help you promote your show and your message and get more people involved, great. Because Wall Street is what ruined 2008. The real estate industry didn't destroy Wall Street. Wall Street destroyed real estate. It started in the mortgage markets because these guys were playing shenanigans with mortgage-backed securities. And my father had the same thing happen to him in 1987, and he got wiped out. And it's, the people that have their hands on the levers at the highest level, they're gamblers, and they're gambling with your life savings. And they don't take it very seriously because they get to keep all the upside if they get it right. And if they get it wrong, they hand you the losses, they hand the government the losses, and they walk away scot-free. And that's exactly what we saw happen in 2008. And so, I'm not a political guy. I'm not about going in there trying to change the politics of it. But if we can starve them by having Main Street investing in Main Street and not using Wall Street, then that would make me a happy man.
Yeah, me too. Now, you mentioned a couple of things there, and it's interesting because, at Freedom Fest, there's a lot of people that look at the economy the way that you and I look at it, and we have a similar view, I'm assuming, just based on some of the names you mentioned already. Bob Murphy, for example, has been a guest on the show as well. They take that data and they make a very, what I would consider to be hyper-conservative investment approach regarding precious metals and such. But before we get into the precious metals versus real estate and all of that, which I do want to talk about, you mentioned 1987. Do you think that we're headed for something similar to the 1987 style situation, or what's your outlook on the overall state of the economy and what this next potential recession may look like?
I think if you read Creature from Jekyll Island and then you read Peter Schiff's book, The Real Crash, read Crash Proof first, which is kind of the book he wrote prior to 2008, warning people that 2008 was going to happen. And then Crash Proof, The Real Crash, his next book after that kind of talks about the cycle. It's a boom-bust cycle, but it isn't moderated by the Federal Reserve. It's actually created by the Federal Reserve. And it really got bad under Alan Greenspan. And in 1987, Alan Greenspan kind of kicked off the era of the activist Fed. And he felt that he could meter the money flow, the supply of money, and mitigate losses. And so when 1987 crash happened, he flooded the market with cheap money. And, I called it the squish factor. If you put a bunch of water in a water balloon and it's constrained in your fist, it's going to come out. You just don't exactly know when or where. And so there's a lot of unintended consequences. Well, right now, you just look at the balance sheet of the Fed, you look at the amount of money printed, you look at how much debt there is in the world. The problems we have today are so much bigger. The frailty of the financial system is so much worse than it was even in 2008. And so we just got back from New York City, where we went to our friends Chris Martinson and Adam Taggart from Peak Prosperity, and they were doing one of their regional summits with David Stockman, wrote the book, The Great Deformation. And that book took me months to read, and the guy's just brilliant. But we had a chance to go see him and meet him and talk to him a little bit. And he's saying what he sees happening is massive deflation. And so I asked him a question, because in another part of his topic, he felt like there was going to be a huge spike up in gold. And normally people that follow gold and look at gold denominated in currency like dollars think that if we have massive deflation, gold will go down. In other words, the dollar is going to get a lot stronger, gold will fall. That's what kind of deflation is. But he said, but I asked him, I said, but are you saying that you see a scenario where stocks will crash, asset values will collapse, and gold will rise? And he said, absolutely. And the thinking behind that is that when the paper assets go no bid, that's going to include bonds. And so the normal flight to safety is to go into bonds. But if they can't fly into bonds, then he's thinking they're going to fly into gold. And it takes, gold is such a thinly traded market, it takes very little money that's out there to find its way into gold to drive the price way up. It's amazing how many people discount gold, don't pay any attention to gold, don't have any gold in their portfolio whatsoever. And if what he envisions happening when these debt bubbles burst, drive people in a flight to safety, not to bonds, but to gold, then from a dollar perspective, it could be a pretty good ride as far as gold holders go.
Interesting. So historically speaking, obviously, over the last several decades, the US dollar has been the flight to safety. So is what you're saying, and is this aligned with your worldview, that time is going to soon pass, in the sense that the US dollar will not be viewed as the flight to safety? And also, can you tie this into why the bond market in particular is so important to real estate investors? Because I think that those two conversations are really critical for people to understand.
Well, yeah. I mean, real estate, the asset values, the prices of real estate are all driven by debt. Because basically everything's financed, and a loan is pulling money from the future into the present. That's debt. And the way you control it is through cash flow. So real estate is the greatest tool ever for strategically using debt, because you can borrow from the future at very low rates. You can fix it. You get all kinds of tax breaks. And then you get to service the debt with the income of the tenants, which is far more stable than the asset price. So the asset price can go up or down, and you don't care because there's no margin calls. There's no other investment out there where you can use 5-to-1 leverage, which is 20% down, and not have to worry about a margin call, even if the property fell in by half. And so you're hedged against inflation and deflation. But that all that money emanates in the bond market. The bond market is way bigger than the stock market. And especially the 10-year. Like right now, the 10-year has just crept over and seems to be holding above 3%. That's kind of a resistance level that it's been bouncing off of for quite some time now. And it penetrated it the last few days, and it's been staying there. Well, it doesn't seem like a big deal to go from 2 to 3%, but that's a 33% increase in debt service expense. If you've got a portfolio of debt out there in the bond market, especially treasuries, where you've got trillions and trillions and trillions of dollars or corporate bonds or whatever they are, and the rate goes from 2 to 3%, the people who have to do the debt service just saw their payments go up by 33%. Well, that was what was behind the subprime mortgage crisis. The subprime mortgage crisis wasn't about the mortgages, it was about the bonds. So what they did was they took these mortgages, these subprime mortgages, and they pooled them all together into what they're called mortgage-backed securities. So you take all these different individual mortgages and you pull them into one big pile, and then you securitize them, meaning you sell people a share of that pile. And the quality of that pile is all based upon the underwriting and the quality of each individual loan. And so they say, okay, we're going to have a certain amount of defaults inside this. But if you exceed that, then the value of that bond falls dramatically. And when bond values fall, interest rates rise, or worse, it goes no bid. And that's what happened in 2008. Mortgage-backed securities went no bid. I was a mortgage broker at the time. I had 100 loans in my pipeline. And all of the wholesale sources I was using were packaging up their mortgages and taking them to Wall Street. And one day there was no bid. They couldn't sell them. And so
the volume just drops to zero.
It went to zero. It went to zero. It was like a heart attack. I mean, just imagine that it's really money circulating through the system, the velocity of money. That's like your blood pumping. It's flowing through the economy. When the credit market seize up, everything stopped. And when everything stopped, now it was impossible. These companies, these banks, large investment banks like Lehman Brothers and all these folks that had levered up were using bonds as collateral because they're considered to be very stable and very safe. And there's always a market for them. Well, when the market dried up and these things were not safe at all, everybody had them on the market. Nobody was bidding on them. And they were having to mark their balance sheets, mark to market on a daily basis. And they were just going bankrupt left and right. And so AIG, the insurance company, had sold everybody these credit default swaps, which were basically saying, hey, if the debt goes bad, we'll make you whole. And they thought it was easy money because this was A paper, never going to go bad. And when it went bad, AIG was done. I mean, in a matter of hours. And I remember those days clearly. And so when the bond market unravels, it's like a massive financial heart attack. And that's the concern. And so when you see interest rates rising, it's because people are bidding less for bonds. And so I like to look at what's going on in the bond market by looking at the interest rate. And if people are coming out of bonds and going into the stock market, okay. If people are selling stocks and selling bonds and going into gold, then that tells you there's a flight to safety. So you can get a feel for where the smart money's going if you know how to read the gauges. And of course, I didn't know how to do any of that, coming into 2008. And so I didn't find out there was a tsunami until it rolled me over. Now I spend a lot of my time talking to people who are out there looking at the horizon. I mean, just think about what we just went through with Hurricane Florence. You got people there living and they're going to the beach and it's sunshine and, they look at the next day weather report. But you got professionals who are out there looking way out into the ocean, seeing what's coming a week, 2 weeks, 3 weeks away. And because those people are pros, they give people a heads up. Hey, folks, guess what? There's trouble brewing. There's trouble on the horizon. And some people listen and are proactive and they go, you know what? Better to be safe than sorry. It's a little inconvenient to prepare, but better to be prepared and not have a storm than to have a storm and not be prepared. There's other people that go, most of the time it blows over, so I'll deal with it when I see it. And there's other people that just, they stay in there till the bitter end and they just go into denial. Well, people respond the same way to financial crises. And the first time I was in that denier category, I just kept thinking, hey, I'm a smart guy. I can hustle. Whatever happens, I can adapt to. And I hear all the doom and gloomers, but it's a headache. It's going to take me a lot of time to understand what they're saying. And does it really relate to me? And so I was lackadaisical about my preparation. And sure enough, I had my back to the ocean when the tsunami hit. And it washed everything I had away. Only thing I hung on to is what I had offshore because it was outside the jurisdiction of the creditors in the States, which is a whole different lesson there, but we won't get into that.
Yeah, it's for a different podcast interview. And you obviously covered just a lot of ground there. One of the things that kind of streaks out to me is the summarization of why the bond market's so important. The bond market is not directly tied to the exact mortgage rates you may get, but it's an extreme indicator, right? So when bond prices increase, you're going to most likely see a one-to-one increase in mortgage rates over an infinite time period, right? It may be a small, short amount of time where that increase happens where you don't see that, but over a long period, that's basically they perform in lockstep. Now, one of the questions that comes to mind is that the United States is in a unique position for a lot of reasons. They are the global reserve currency. It's a massive country, and it has been in this position for decades. How do you think that interest rising will impact the overall, given the nature of the global economy, the global financial markets, how do you see this taking place? Because other countries are in such bad situations as well. I mean, we've never had greater global debt to GDP, and there's a lot of countries that are very large countries that are also very struggling. So what are your thoughts on that?
Well, we have to solve the productivity problem. Debt is manageable with productivity. And, a lot of times people get hung up in these economic concepts, but really it's just the same as your normal life. I mean, if you have a job and you're making a certain amount of money, you can afford to service a certain amount of debt. If the interest rates go up, you can service less. And so the answer is either to reduce your debt, reduce your interest rate, or increase your productivity. And so there's a marginal what they call marginal productivity on debt. So for every dollar of debt that you go into, are you making money on the debt or are you losing money? We got a guy in the White House right now that's a real estate guy. He looks at debt, he thinks of debt differently. All debt isn't the same and all investment isn't the same. But, if you borrow and invest in something that you get positive arbitrage on where you create more growth than cost, you can get away with it. Now, it remains to be seen if we're going to do that. Just like there's a big difference between having a manufacturing economy and a financial economy. And so, the world right now is faced with this issue that it's got a lot of debt to service. And the whole thing is held together on faith. You believe that your counterparty will perform. As long as you believe that, then you don't panic and you don't sell the asset. Because remember, a bond is an IOU. And it's sitting on your balance sheet as an asset, but it's sitting on somebody else's balance sheet as a liability. And if they fail to perform, then your asset goes to no value. And so this is where a lot of income investors right now who are in the bond market are at risk because their principal value is in jeopardy. As interest rates rise, the principal value of the bond drops. And if there's actually a default, I mean, I remember in the midst of the 2008 financial crisis, I was at a very, very nice home in Newport Beach. And I was talking to a woman who had been recently widowed, and she was a wealthy woman, and she had all her money in Fannie Mae.
Wow.
And Fannie Mae was considered to be very, very safe paper. Well, it turned out to be disastrous, and she got wiped out.
Wow.
Because she had counterparty risk. So our system right now is full of counterparty risk. And most people do not understand that. They don't understand their bank account is counterparty risk, their bail-in provisions, outside of your $250,000 per account FDIC insurance. They could take all your money like they did in Cyprus. Those provisions are in the U.S. law right now. It's part of the Dodd-Frank thing, and it took effect in January of 2014. Very few people know that. Very few people understand that when they own stocks, they don't really own stocks. They have IOUs from their broker. Their broker owns stocks. Those companies that you own stock in don't know that you exist. That's why they send all of their annual reports and proxy statements, all that stuff go through your broker, because they're the owner, not you. And if the broker fails, then all you have is a claim on assets. So you're an unsecured creditor to your bank. You're an unsecured creditor to your broker. If you own a bond, you're betting on the person to be able to pay you. Governments and municipalities can and do go broke. So the real saving grace for the United States, what makes it so safe, and you brought it up earlier, Hunter, is the reserve currency status. We have the ability to print dollars, and the entire world needs them. And this is the whole thing. I mean, I think you saw the video. I did a 45-minute presentation at Future of Money and Wealth, and I kind of broke down exactly what being the world's reserve currency means to the United States, how we got in that position, because we've only had that since 1944. Prior to that, it was the British pound. They lost it for a reason, and we gained it for a reason. Well, guess what? China is watching. And they're doing exactly the same things the United States did in order to get in a position to take over. And they've said overtly that they want to. Russia is aggressively looking for alternatives to dollars for trading oil. Russia's the largest producer of oil in the world. China's the number one consumer. So I'm not saying the dollar is going to go bust tomorrow, but what I'm saying is for the rank and file investor out there, they are swimming with sharks and they don't even know it. They don't even know what they don't know. And that's why we produced that Future of Money and Wealth series, because we said, gosh, we're going to get on this cruise ship with our summit. We're going to have Robert Kiyosaki and G. Edward Griffin and Chris Martenson, Simon Black. We're going to have Peter Schiff. We're going to have all these brilliant people, Tom Wheelwright. We're going to have all these people. Let's do a 2-day seminar and just talk about the future of money and wealth, because so much has changed. We got to do tax law. We got to do president. We've got, kind of a whole new outlook on the way things are going. We learned a lot from 2008, but we changed a lot. The rules are different. The banking rules are different, just a lot. Let's take 2 days. Let's record the whole thing. So I kind of kicked it off with this expose, if you will, on what I've observed since 2010. In the wake of TARP and all the printing and the growth of the Fed's balance sheet, we basically were signaling to the world that we were willing to throw the dollar kind of, into a downward spin in order to prop up our financial markets. And so the premier from China at the time came over and kind of scolded President Obama publicly about making sure that he took good care of their investment, because they hold trillions and trillions and trillions of dollars of dollar-denominated treasuries. Well, since then, they've been systematically taking all kinds of steps, putting in international banks and getting their currency, the yuan, to be accepted in the IMF and part of the SDR bucket. And they've accumulated a lot of gold, and they've created, their whole Silk One Belt initiative. And a lot of that is
right. I was going to ask you about that. I was interested about that specific topic. What are your thoughts on that Silk Belt Road initiative?
Well, I read an article the other day, and somebody else kind of had the same perspective. But, if you really understand how the United States works, the entire key to propping the dollar up is having demand. A currency is like any other commodity, and its value is based on supply and demand. And so you have to create demand. So when we defaulted on the gold standard in 1971, the world abandoned the dollar. We had inflation in the United States. Oil went way up. They blamed it on, we're going to run out of oil and oil shortage. But it was just the dollar collapsing. They'd already confiscated the gold in 33. They confiscated basically the silver. They took all the silver out of the coinage in 64. The United States was going broke, and it culminated in us actually defaulting on the world in 1971. Prior to that, the world could hold dollars and return them to the United States and redeem them for gold, because gold was real money dollars were just a derivative of gold. All that changed in 1971. And so the United States went out and made a deal with Saudi Arabia and said, hey, you've got all the oil. Oil is the number one traded commodity in the world. If you will trade oil in dollars and dollars only, that'll create huge demand for dollars, which we need right now. We've got this big army. We'll make sure your kingdom lives forever. And so that's why we've been so active in the Middle East. Now, if you look at, U.S. geopolitical policy over the last 40 years, it's had a ton to do with oil and protecting the dollar. And so China saw this. So the other way that you create demand is if you make loans to people in dollars, they have to earn dollars to pay you back. Think about that. So the United States runs around and makes all these loans because they have the power of the printing press in dollars. And then people in all different countries have to earn their profit in whatever currency they have and then turn around and sell that currency and buy dollars so they can pay their dollar-denominated debt. The Chinese looked at that and said, hey, we can do that. So they created the Asia Infrastructure Bank, and they spearheaded the Silk Road and the One Belt Initiative. And they're lending money to all of the countries that are going to be the beneficiary of this piece of infrastructure. And they do it ostensibly because it's going to stimulate Asian economy. But really what they're doing, they're enslaving all of those countries to them in debt and forcing them to have to go produce to earn yuan to create demand for Chinese currency.
Yep.
And so if you don't understand the way the markets work, you don't understand what's going on. And, starting now, the countries are starting to figure it out.
Well, the defaults are starting as well.
Well, yeah, because, and then you get the whole thing going on, with the Fed and their quantitative tightening and dollars coming out of circulation. The emerging markets are getting crushed. So their currencies are falling because they have to sell lots of them. And they're bidding up the dollar. So the dollar is strong, but only in comparison to other currencies. And so, I look at it like a big ship. If you can imagine a big ship on an ocean, and in the back of the boat is Zimbabwe and Venezuela and all the currencies that have already, are not worth much. And at the front of the ship is the dollar. And in between, you can order them however you want. And all of a sudden, the ship starts to sink. And so the back of the ship, where the weaker currencies are, it tilts downward and the front of the ship begins to tilt upward. And so comparing where the weaker currencies are to the stronger currency in the front of the ship, it looks like the currency's rising, but they're all on a sinking ship. And then as the ship begins to sink and currencies fail, the emerging markets fail, everybody's piling into the safe space up at the top, the dollar, flight to safety that you mentioned earlier. And that creates upward pressure on the dollar. The question is the dollar a life raft? Or is it just the bow of a sinking ship? And if there are life rafts, what are those life rafts? And that's where people look at things like gold, where there are no counterparty risks and real assets. So these dinghies are sitting here on the side. And of course, the people at the ship are going, hey, it's all good. Strike up the band. We've got this under control. Well, we'll see if they have it under control. I think that if they have it under control, great. If they don't, I want to have a plan B.
Makes sense. And I think that gold is a big part of that plan B for you. Before we kind of change the topic from the macro trends, there's something I need to ask because I think it's definitely worth considering. And you do touch on it a little bit there with the discussion about gold. But when I hear talk about the dollar collapse, something that comes to mind for me is the situation in Japan. Most of the problems that the U.S. is facing, they're facing many demographic shifts, the overburden of debt. The problem is just 2 to 4 times worse in Japan. So, you've got the debt to GDP, for example, in the US is about 100% or 105%. Japan is about 250%. The US 5-year bond is about 2.78%. The Japanese 5-year bond is about negative 0.08%. So there's no room to go, basically. Everything gets worse. People talk about the demographic challenges with the baby boomers in the United States. Japanese population is literally shrinking on an annual basis, has been since 2011. So my question is, what's your perspective on the situation in Japan? And is it one of those cases where this can go on much longer than people can imagine, in the sense that if the U.S. was in Japan's situation now, most things wouldn't change? What are your thoughts on all that?
It's interesting because I was talking with Robert Kiyosaki about this the other day, and it was like, are we Japan? Of course, he's Japanese, and so it's not the reason for his interest, but it's just like, is the United States heading down the path of Japan? We could be. A lot of the things that Japan has done to get to where they are, we're doing. We're having a lot of the same issues. But with that said, we obviously have a much larger population. We have a much more resource-rich country. We have a lot of advantages, not the least of which is the fact that we do hold the world's reserve currency. And as long as we have that, we have some flexibility to be able to dig ourselves out of this hole. Now, whether we do it or not, that remains to be seen. Japan, their central bank is buying basically 100% of their government debt, meaning that they're basically just printing money to operate. And as long as they can sequester the inflationary effects of that, which they've been able to do in spite of their enormous efforts, Abenomics and the whole thing, we're trying to create inflation. They've been unsuccessful at doing it. Part of that is cultural because the Japanese are savers, and it's hard to get them to stimulate spending. The other thing is when you're in a deflationary environment, you wait to spend. You get what you need, but if you feel like, hey, it's going to be cheaper tomorrow. So there's a lot of dynamics going on there. And of course, Japan has been kind of part of the alliance with the United States, and they buy each other's bonds and do things to prop each other up and pass the baton of monetization back and forth. So even though they're in the East, they're really part of the West as far as economics go. So I think part of Japan's future is going to be predicated on the United States' future and a friendly working relationship. President Trump is out there bickering with a lot of folks, but Japan's not one of them.
Yep.
And there's probably a reason for that. So I can't say that I'm an expert on Japan. I'm paying attention to it. I certainly look back and remember when everybody thought they were going to take over for the United States. And, and maybe they could have, I don't know. It's the same thing. China could become Japan also. They quickly figured that out. They used to have the one child limitation. And, in a communist think, when everybody is a ward of the state, people are a liability. When you begin to adapt a capitalistic approach, especially if you're going to put some emphasis on domestic consumption, all of a sudden you realize that people are an asset.
Yeah, exactly. That second and third child can invent a product that'll increase your productivity as a country or, as a currency, et cetera.
Yeah. So they see, I think that they've got a demographic problem they need to fix, and they realized it and woke up and changed their policy. And so the one thing that I can say about the Chinese is the Chinese, I think, are world renowned for their ability to look at somebody else's idea and copy it. And they've been studying. They've looked at Japan. They've looked at the United States. They looked at Britain before that. They play a long game. They're not accountable to voters in the same way the United States are. They don't have, they got corruption just like the United States does, for sure. But what they don't have is the same kind of myopic short-term thinking. Same thing like corporations here, managing quarter to quarter. It's hard to play a long game when you have to answer to Wall Street every quarter. And so, there's that. And then the other thing is you never quite really know what's going on in China, because if you have ever read The Art of War, there's a lot of misdirection in Chinese philosophy. They're perfectly happy to feign the role of being weak or in trouble when in fact really they're strong. One of the things, the other speaker that was at the New York Summit with Chris and Adam in New York was Jim Howard Kunstler. And one of the comments he made, and I've heard this said by some people in the gold community, is that, it wouldn't be surprising if one day China just showed up on the world stage and said, hey, everybody, you know what? We actually have 25,000 tons of gold, and we're going to back the yuan with gold. And now, all of a sudden, the currency at the front of the ship changes, and it pushes the other currency back down towards the back of the boat. So I'm not saying they're going to do that, but China has been the world's largest producer of gold and the world's largest importer of gold. And right now they're sitting allegedly in sixth place behind Russia, who's been aggressively dumping treasuries and buying gold. And so whereas you look at Japan, and Japan is very much of the Western philosophy, a lot less about hard assets. It's a lot more about playing paper games. And whether that coalition of the paper players can stand up against people that are dealing in oil and gold and real productivity with manufacturing. It's hard for me to imagine that given enough time that people playing paper games are going to be able to stand up against people that have real productivity and real assets. And that's why I watch.
Yeah, pretty remarkable. And the reason you watch is what we're about to get into. So first of all, thanks again for going into that regarding the macro stuff. It's all so fascinating. But sometimes it can feel like it's something that people do as a hobby. They just like to do it, it's entertaining, etc. But I know that your approach is really focused on the actual impact it will have on your personal finances, your investors' finances, your network's finances. So how does all this tie into real estate? Because this is a really important question that I don't think get asked enough, because many of the people that view the economy the way that you and I do, they're not actively involved in the real estate market. So how does this information impact the way you view real estate investments, and what type of real estate investments are you a proponent of, given your perspective on some of this?
Well, I think real estate's part of a portfolio. And I think that one of the things that I did, because when I first started in the mortgage business, prior to that, in between my career in corporate sales, I spent some time in the financial services industry and studied financial planning. Not a CFP, nothing that fancy, but I'm a studious guy, and looked at the way that traditional financial planners look at portfolio modeling. And it just, to me, it didn't work, because what was missing was firewalls. I've been on a lot of cruise ships. Every year we do our annual investor summit at sea. And cruise ships have bulkheads. They have these walls. And so if the ship starts to go down, these things seal off and isolate the problem. And so I really think a portfolio needs to be constructed that way. And so what I came up with is kind of my own way of looking at it. I call strategic real asset investing. And it's rings of risk. And so I take a kind of a target with concentric circles, and I divide it into quadrants. And on the left side is income. On the right side is equity growth. You've got inflation to the top and deflation to the bottom. And at the center ring, you've got no counterparty risk, highly liquid assets like physical cash in your hand, physical metals, physical gems outside the banking system. Another ring out would be guaranteed accounts by strong financial institutions, and then a little further out would be things like free and clear real estate. A little further out would be leveraged real estate. And you kind of get the idea. And so the idea is that, you avoid things like personal guarantees. You have stop losses set in your mind so that you don't drain the center of your portfolio, the safer part of your portfolio, to feed a losing proposition. I had my ego get in the way. When things started to fall apart, I kept thinking I could save it. So I kept taking money out of my home. I took money out of my retirement account. I took money out of things that should have been my safety net. And I pushed it all out to the edge, to the margin of my portfolio, trying to save deals that I should have just put a fork in, but wouldn't do. And that was a big mistake. Instead of losing a little, I lost a lot. And I don't blame the market for that. That was me. It was me not being prepared for what was going to happen. So to me, real estate is an ideal investment because it hedges against both inflation and deflation. And the way it does that, the obvious against inflation, is that if dollars lose value, then anything denominated in dollars go up, including wages, rents, and asset values. You can fix the debt, which is effectively shorting the dollar. So I'm going to bring dollars in from the future to buy the asset today. I can fix the rate. I don't have to worry about margin calls. As I mentioned, I can use lots of leverage. I can pick up great tax breaks. So it's great against inflation. A lot of times people think, but what about deflation? Well, look at it this way. If I go buy a $100,000 house and I put $20,000 of my money down and get an $80,000 loan, and I underwrite that thing so that, it cash flows. Historically, asset values might crash 40 or 50%, but wages don't. You go look at 2008 or any time. I mean, certainly, incomes on real estate can be hurt. And this is where market selection and product type matter a lot. Because if you pick something top of market, if you pick a top market, if you pick the top price point in a market, then there's nobody above you to create demand in hard times. You're going to be the first one to go. But if you're in the middle of the market, then in good times, people from below you push up and create demand. And in bad times, people above you come down and create demand. So I think that when you understand that, and then of course, picking markets that are like that, same thing, right? Secondary, tertiary markets right now, because primary markets are so inflated, is where investors are having to go to find cash flow that makes sense. But coming back to this $100,000 house, so let's say the property drops from $100,000 to $50,000. There's no margin call. Yeah, you still have an $80,000 loan. You're trapped in the property. You're underwater, but you have rents. You have cash flow. At some point down the road, that property is paid for by the rents. And so you only ever put $20,000 in, and you have a property that's free and clear. And in any marketplace, no matter what currency is being exchanged or what the valuations are, a property that's paid for is providing a very tangible utility to society. And kind of the going rate is about 20 to 30% of somebody's productivity. So somebody's going to go to work every day and send me about 25 to 30% of their money for the privilege of living in my home that's paid off. So I feel like I'm hedged against deflation with real estate because of the way I use leverage. And then you add to that the mix of using insurance, and I hate to use the word insurance, but I definitely don't look at gold as an investment. I look at it as an alternative form of savings, a place to keep liquidity. There's, seems to me there will always be a bid on gold. Could be wrong, but it seems like there will always be a bid on gold. And so that's a great asset to have because it's not subject to counterparty risk. There's always a bid. You can convert it into whatever currency is of value at the time you do the conversion. And it's a way to hedge against failing currencies because it'll just take more of whatever currency. And people look at gold and they're like, well, I don't understand, they're like, I don't see gold as an investment. Well, it's not an investment. So I agree with you. It's not an investment. It's an alternative form of cash. Yeah, you want to have some cash, but I think you also want to have some gold.
Are you considering and investing in single family properties or mobile home parks or apartments? Like, where does that fit into you when you talk about the asset class in that narrative?
I think residential real estate is great for a lot of reasons. One is people will always need a roof over their head. They talk about disruptive technology, but it's unlikely anytime in our lifetime somebody's going to create a technology that makes having a roof over your head obsolete. So there's always going to be a demand for housing. I mean, you've seen retail, as the retail business has changed, retail properties have been hurt, as the economy comes and goes, office space, industrial space can come and go. So I like residential. Mobile homes are great because they're not making any more of them for the most part. And they definitely are the lower end of the market, which means that in hard times there will be demand. So if they make sense today in a good market, they're only going to be more valuable in a down market. So mobile homes make a lot of sense to me. Apartments, if you can find the right deal. I mean, right now, everybody's kind of figured apartments out. And part of that is because affordable housing is always high on the government's list. So whoever's in charge is always going to be looking out for housing because if you don't take care of housing, then that's where revolts happen, pitchforks, and it gets ugly. I mean, food and housing are the two core things. So to me, when there's a lot of unreal debt and fiat fake money running around, doesn't mean you can't use it, doesn't mean you can't profit with it. But I think you need to have a base of things that are real. And to me, food and shelter and commodities are fundamental. And if you have them structured properly in terms of how you're holding them and who has claims on them and how exposed you are in a litigious society, when people get desperate, and especially in the United States, the land of frivolous lawsuits. But if you have everything structured right, then you have a better chance than almost anybody to weather the storms. And that becomes kind of the basis of your real asset portfolio. And then from there, you can go out and buy paper and you can do futures and you can, do speculative stuff. Just make sure that you have firewalls so that your home base is never threatened.
Makes sense. And that's a good question, actually. Are you doing anything, speculative like that? Are you shorting anything? Are you staying away from anything?
No, I keep it simple. We've got most of our focus is in what we're doing offshore in Belize. We're the largest real estate developer in the country of Belize. In fact, we just got awarded, I think, Hilton's Developer of the Year award. I just learned about that yesterday. Hasn't even been announced. And we launched that project in the pit. I mean, we were like, it's going to be one of these great stories someday when we tell the whole story about where we were at when we started that project and what we had to work with or didn't have to work with. It's just amazing. And so my partners on that have been just amazing. Just so proud of them. There aren't even words to say how hard they've worked and how much they've accomplished and what an uphill slog it was. But so far it's going well. So that's been a real focus. Candidly, after 10 years, I'm still cleaning stuff up. It takes a long time to mop up the mess because, I had a decent sized portfolio. I had a lot of different business interests. I had foolishly signed personal guarantees on failed projects. So there's just a lot to clean up. So it's just easier for me to go rebuild offshore. So that's really, on a personal level, that's kind of, my emphasis is making sure I got a good, strong base and I have projects and things that I'm doing that my personal investment philosophy is I'm not a deal guy directly. I always do deals with people that I know, like, and trust, both in terms of competency and ethics, so I can focus on doing what I do. So not really passive, but definitely not active. I'm kind of somewhere in between.
Yep, I can relate to that both structurally and for the things that I look out for in operators. So you've obviously been through a lot. You've been through multiple cycles, experienced one of the most significant downturns in the history of the United States. I was wondering if you could share with the listeners something that you wish you learned earlier, something that you could say to young entrepreneurs that are just getting in the space right now, something that could really help maximize their time when it comes to focusing their efforts on something that'll accomplish their goals.
Wow. Well, I've been through so much. It's a huge laundry list. I had a chance to interview Donald Trump before he was president. He was just getting ready to announce, and I found myself at a land expo in a press room with him. And I asked him, what did you learn in the good times? And what did you learn in the bad times? And one of the things he said in the bad times is he learned was, it's always good to have a little cash. And so one of the things that hurt me in 2008 was I was really dependent on the credit markets. I brokered credit because I brokered loans. I operated the business on credit lines. I had excellent credit and huge credit lines available. So I'd run up my American Express and pay it off. And so I didn't have any cash on hand at all. And when they started shutting my credit lines down, I didn't have any cash. So, always make sure you have some liquidity. I think that's really, really important. I think the other part is realizing where you are in a cycle. I did a newsletter, I think 2 or 3 weeks ago, called Don't Get Lost in the Lag. And there's a lag. We saw people run into the Bakken, or prior to that, they ran into the Go Zone in New Orleans after Katrina. And these were temporary situations that created a spike in demand relative to supply. And so there was a lag, a production lag, and people bought in for the long term based on a temporary phenomenon. And we stayed away because we said, it's going to attract a lot of developers, and developers get in and out. They're going to come in, they're going to build, they're going to sell, and the long-term buy and hold guy is going to inherit the market and what it's going to be 10 years from now. And it's not going to be the same market. It's not going to be the same demand in the market. Sure enough, that happened at both those places. So always be aware of that there are cycles and where you are in the cycle and what the signs of the cycles are so you can recognize them. And I think, and I could go on, but I'll just close with this last piece, is we did have people in our ears, but I was too busy being the smartest guy in the room. And so even when Kiyosaki was trying to tell me, I couldn't hear him. All I did was spend my time trying to prove I was smart, because even though I wouldn't do it to his face, behind closed doors, I would argue the other side of it. And I believed my own BS. And that was a huge mistake. What I should have done is listened with an open mind. And I should have tried to understand what he was saying and why he was saying and what he understood that I didn't understand. Always be aware that you have something to learn. You do have prejudices and blind spots. It's always good to get a 360, and it's never good to be the smartest guy in the room. Get into the best rooms you can be in. And like I shared earlier in my conversation with Richard Duncan, don't be afraid to get into those conversations. It's how you learn.
Yeah, gosh, there's so much great content in what you just said there, particularly you mentioning that you disagree with him behind closed doors. The whole point of having those networks is to put forth those arguments, to understand where your arguments are weak. You have to leverage, you have to be able to say, this is the way that I'm seeing it. Why am I incorrect? And that way you're actually going to learn. So brilliant stuff. Now, before we wrap up, let's just let the listeners know how they can learn more about you, your firm, and get in touch with you.
Well, I alluded to several times the video series, and so I'm really anxious to get that into people's hands because it's kind of an eye opener. So, if anybody wants to learn more about the real estate guys and the Future of Money and Wealth video series, they can send an email to future cash flow at realestateguysradio.com. And we'll send you a link and tell you about how you can get the series if you're interested in it, and learn about our podcast and get onto our newsletter. And, if you like what you heard from me, there's just a lot more of that. I mean, we've been doing it since 1997, 10 million downloads and counting. So it's a lot of fun. And, I think that we bring a unique perspective, because I think that we're tied into some super smart people that think outside the real estate box, which is really important. And then we take what we learn from them, we relate it back to the street level so that it's actionable. Our motto at the Real Estate Guys radio show is education for effective action.
Awesome. I love it, Russ. Well, thanks again for coming on. Let's have you on in a couple months to discuss some other topics as well.
Yeah, I look forward to it. Thanks for having me.
All right, listeners, thanks for checking out the episode. As always, the contact information for our guest will be available in the show notes page, which is hosted on SoundCloud, iTunes, and Stitcher. Don't forget, if you want access to some of the free goodies that I'm talking about at the beginning of these episodes, like free ebooks, weekly investor emails, and articles about some of the most important investment-related topics, make sure that you have created an account with CFC because this stuff is automatically available. You can do this by going to cashflowconnections.com and signing up as an accredited investor. Of course, if you have any questions, feel free to email me at hunterthompson@cashflowconnections.com. Thanks again.